Trading and investing require skills, discipline, and patience to succeed. Trading and investing demand skills, discipline, and patience for success in the financial markets. Short-term, swing, or opportunity trading demands a high level of skill and discipline to navigate the stock market. Explore our educational videos for a comprehensive understanding of various trading scenarios with us. Day trading. Day traders buy and sell financial instruments within the same trading day, aiming to profit from short-term price fluctuations. Positions are typically closed before the market closes to avoid overnight risks. Day trading involves buying and selling financial instruments within the same trading day, aiming to profit from short-term price movements. Traders often use technical analysis and leverage to capitalize on small price fluctuations, requiring quick decision-making and risk management skills. Swing trading. Swing traders hold positions for several days to weeks, aiming to capture short to medium-term price movements. They often rely on technical analysis and market trends to make trading decisions. Swing trading entails capturing short to medium-term price movements in financial markets. Traders typically hold positions for a few days to weeks, aiming to capitalize on upward or downward price swings. This strategy often combines technical analysis with fundamental analysis to identify potential entry and exit points, emphasizing risk management and disciplined execution. Position trading. Position traders hold positions for weeks, months, or even years, focusing on long-term market trends. They aim to capitalize on major price movements and economic cycles. Position trading involves taking long-term positions in financial markets, with trades lasting from several weeks to months or even years. Traders using this strategy focus on fundamental analysis and macroeconomic trends to identify opportunities, aiming to capitalize on broader market trends rather than short-term price fluctuations. Position traders prioritize risk management and patience, allowing their positions to unfold over time to realize potential profits. Scalping. Scalpers aim to make small profits from numerous trades executed throughout the day. They focus on exploiting small price gaps and liquidity imbalances in the market. Scalping is a short-term trading strategy where traders aim to profit from small price movements by executing a large number of trades within a short period. This strategy requires quick decision-making, precise timing, and access to real-time market data. Scalpers typically target highly liquid markets and use technical analysis indicators to identify entry and exit points swiftly, aiming to capitalize on small price changes for incremental gains. Algorithmic trading. Algorithmic traders use automated systems to execute trades based on predefined criteria, such as price, volume, and timing. These algorithms can analyze vast amounts of data and execute trades at high speeds. Algorithmic trading, also known as algo trading, involves using automated systems to execute trading orders based on predefined criteria and algorithms. These algorithms analyze market data, identify trading opportunities, and execute trades at optimal prices and speeds, all without human intervention. Algorithmic trading strategies can vary widely, from simple to highly complex, and are designed to capitalize on market inefficiencies and trends with precision and efficiency. Trading and investing require skills, discipline, and patience to succeed. In conclusion, trading and investing are not just about making quick profits but also about developing the necessary skills, maintaining discipline, and exercising patience. Success in the financial markets comes from continuous learning, prudent decision-making, and the ability to stay calm during market fluctuations. By mastering these attributes, investors can navigate the complexities of the market with confidence and achieve their long-term financial goals.